Welcome to the Smart College Buyer Podcast. My mission is to help high school families pay for college without taking on a truckload of debt. Each episode, I'll share insights into college admissions, financial aid, payment strategies, and more, often with expert guests. I'm Jack Wang, your host. I started helping families after struggling to navigate the process myself for my sons. If I needed help, I knew others did too. Let's dive in. Hey everyone, welcome to this episode of the Smart College Buyer Podcast. I'm your host, as always, Jack Wang. Great to have you here. And by the way, this picture behind me today is the main building at Clark University in Worcester, Massachusetts. Clark is a private liberal arts research university. You don't often hear those terms together. One of the claims to fame of Clark is that it is the only college where Sigmund Freud ever taught in the United States. So one of the largest majors at Clark is psychology. But I also picked Clark because of its relation to today's topic, which is all about financial aid formulas. I know, oh my goodness, stay with me. I promise I'm not going to put you to sleep. But it's important to understand about the formulas. So we're going to talk about what the two main formulas are, and in general, kind of what they consider and what they don't consider, but also how it should be a factor in your college planning process. Most people don't think about it till the end, but really you might want to think about it more towards the beginning. So with that, let's start. Colleges use one of two basic formulas. One formula is what we call FM, or federal methodology, or a FAFSA only formula. And you can always tell if the school uses this because if you go on a school's website, you look under the financial aid section and how to apply for aid, it only requires the FAFSA. But other schools, notably Ivy Leagues, those private schools near Ivy Leagues, so one step below, and even a number of what we call public Ivies, or public schools that are really considered sort of top tier, they use a different formula called the CSS formula, or we call it the IM, institutional methodology, or sometimes we call it the CSS or the profile schools, because those schools require the FAFSA and another form called the CSS profile, which is a much longer, more comprehensive form. Okay. Now, having said that, one of the reasons I picked Clark as my background is because schools can and do change between formulas. So Clark years ago was a CSS school, then for a while became a FAFSA only school, and now is back to a CSS school. And in fact, schools can use a combination. So Clark in particular, when they were a FAFSA school, they weren't just FAFSA, they were what I call FAFSA Plus, which is they use the FAFSA as well as a separate form which required families to report certain other financial items that were not on the FAFSA, but you commonly find them on the CSS, but they just didn't require you to fill out the entire CSS because it's really long. Now, there are differences between the formulas, all right, and there's differences between the formulas and tax returns. So I'm going to talk about some of these things at a really high level. But before I get into that, I want to talk about sort of how schools use this information, if you will. So aid in all of its forms, right, comes from three main places. There's others, but the three main places are from the federal government, from state government, or from the school itself, right, which is often known as institutional aid. And actually, the largest pot is actually, for a given student, is actually the school's own money. So at a profile school, or a CSS school, or an IM school, however you want to call it, they use the FAFSA to figure out how much federal or state aid a student may qualify for. But they then use the CSS form to figure out how much institutional aid the student may qualify for. So sometimes families ask about, should they even fill out a financial aid form, or should they just do a FAFSA, not the CSS, for a CSS school? To which I would say, you always fill out the financial aid forms, because otherwise you're telling the schools that you don't need the money, right? Like, you're ready, willing, and able to pay full price if you're not even bother applying for aid. But at a FAFSA school where there's only the FAFSA, schools use the FAFSA information to determine federal and state aid, but then they use the same information to determine institutional aid. And keep in mind, institutional aid, again, is money from the school's own pocket, so I can't emphasize this enough. It is their money, so they get to set the rules. With that, all schools use the same basic overall financial aid formula. They start with the cost of attendance, or COA as we sometimes call it, or basically the sticker price. So this is where you see in the news, like colleges cost like $95,000 a year these days, right, for some of the most expensive colleges in the country. All right, so that's tuition, mandatory fees, housing and food, books, transportation, miscellaneous. That's like the $95,000 number. From that, they then subtract what is today known as your SAI, or Student Aid Index. It used to be called EFC, or Expected Family Contribution. But regardless of whatever you call it, is how much the college thinks you can afford per year per kid. People always say, well, that number is too high. How can they possibly think I can afford that amount? It's not what you can actually afford, or what you think you can afford. It calculates what colleges think you can afford. And by the way, that doesn't necessarily mean that's what you're going to pay. You might pay more, or you might pay less than that number. But it is not a score. I see all the time people like filling out the FAFSA that says, oh, I got an SAI of blah, blah, blah number. What does that score mean? It is not a score, right? This is not a video. It is a game, but it's not a video game, right? You're not like shooting zombies here or anything, okay? It is a dollar amount. Once you take cost of attendance minus SAI, that determines the overall need-based eligibility. But colleges then from that can then subtract what's called OFA, or other financial assistance. Now, OFA could be merit scholarships from the school. It could be outside scholarships from like the local chamber of commerce or some other community organization, or it could be other aid from state programs. Like if your state offers like a scholarship program or something, or aid for like if you go into certain majors or whatever, you all subtract that. And then that bottom line number is what we consider really sort of the true financial aid eligibility. Now, I said eligibility, not a guarantee or anything. If that bottom line number is positive, more than zero, then you are eligible for need-based financial aid, but that does not mean you will get it. Now, there are a number of schools around the country that are so-called full need met, or meets need. So what they do is if that bottom line number is a positive number, they will give you 100% of that number. All right, so you get some financial aid, but keep in mind, you still have to pay what they think you can afford, right? So college isn't free. But most schools are not need met, or full need met. Most schools will meet that bottom line number, if it's positive, somewhere between 50 to like 75% is pretty typical. Now, if that bottom line number is negative, that means that you don't qualify for any need-based financial aid. And people will say, oh, well, that's terrible. I guess I don't qualify for aid, or that's unfair, or whatever other things that people say. And I get it. But at the same time, if you don't qualify for need-based aid, it actually gives you the most financial flexibility. We're going to talk about a little bit more about that in just a moment. So a lot of people think it's a negative, and a lot of times it can actually be a positive if you know what you're doing and you know how to play the game. Now, let's talk about the formulas overall. In general, both formulas look at income and assets. What you made, what you own, period. For income, it counts things like, your wages from your job, any rental income, self-employment income, capital gains, interest, dividends you might earn on your bank account or investments, things like that. But there are some differences. So for example, For many folks who work for a company, you contribute to the company 401k or some other retirement plan, right? Pre-tax. So it lowers the amount of your taxes that you owe, but also lowers the amount of your take-home pay because you're saving for retirement. And that is a good thing. So at a FAFSA-only school, your income is lowered if you contribute to a retirement account. But in the CSS world, that's not the case. Because after all, think about this. If you make money, like earn money at your job, and then you put part of it into the retirement plan, right? You don't, it's not part of your take-home pay because you've set it aside, okay? But you still earn the money, right? You still got paid the money, but you made a voluntary decision to put that money over somewhere else. All right. So in the CSS world, that contribution that you make to the retirement plan, that's added back as your income. So the more you contribute to a retirement plan, it actually does not lower your income for financial aid purposes for CSS schools. Other things that go kind of along with that are things like contributions to flex savings accounts, FSAs, like for medical care or whatever, or even HSAs, health savings accounts. After all, those are typically pre-tax contributions, but you chose to put the money that you earn over there. Some of the other things on the CSS side that are a little bit different are things like if you're self-employed, or let's say you have rental real estate and you show a loss, okay, especially because of things like depreciation. Now, depreciation is an accounting term. It's really a non-cash item. I won't really get into it. If you're not familiar with accounting, don't worry about it too much. But for those of you who are familiar with accounting, then you know what I'm talking about. But sometimes, for tax purposes, you can take these losses. Well, in the FAFSA world, because it's all based on the tax return, if you have a loss because of a loss on rental real estate or a loss through your business, then your income is lower because of that loss. But in the CSS world, that's, again, is not true. Those losses that are allowable for taxes are generally added back to calculate income because, after all, things like depreciation is a non-cash expense. You didn't actually pay out money for depreciation. So your income, again, can be higher in the CSS world than it is in the FAFSA world. Now, the CSS has other exclusions and things like that, but there are some differences here. On the asset side, right, there are some differences also. So generally, you report what you own. Bank accounts, college savings accounts like 529s, investment accounts like if you have a brokerage account or stocks or mutual funds, or if your company gave you stock, called employee stock options, or you have employee stock purchase plans, things like that. And generally, they exclude the same things. So, for example, retirement accounts. Any money that is already in a retirement account, like an IRA, a Roth IRA, a 401k, 403b, those are excluded in both formulas. But again, here there are differences. So one of the major differences is in 529s or college savings plans. So, for example, let's say your family has 3 kids, right? And the oldest one is the one going off to college. And let's say you have a 529 for each one of the kids. So in the CSS world, if you, the parent, are the owner of those 529s and each of the kids are the beneficiaries, right, on each of the 3 accounts in our example, then you will report all 3 529 accounts because you as the parent are the owner. But in the FAFSA world, even if you own all 3 529s, you only report the one for the student that's on the FAFSA. So in our hypothetical example, it'd be the oldest kid, right? Let's say the oldest kid's the one going to college. You would not report the other 2. So that's a difference. So the CSS also, the other major difference is the value of your primary residence. So the home that you live in the FAFSA world, I don't care how much equity you have or how much your house is worth. If that's your primary residence, it's a big fat 0 for the FAFSA. But for the CSS, the equity in the home, so the value minus whatever you have on the mortgage, that counts as an asset. All right. So if you have $1 million home with no mortgage, most CSS schools would treat it as if you have an extra $1 million just sitting in your bank account, no different. Second homes, retirement homes, vacation homes, those always count. Personal property never counts. So if you have jewelry, I don't care if you have a Ferrari sitting in your driveway, if that's your personal day-to-day car, personal assets do not count, right? However, one of the things that people often sort of have this misconception, you can see articles on this all the time, don't save in your kid's name or whatever because it's bad for financial aid. Or take all the money you have in your bank account, go bury it in your backyard so you don't have to report it for FAFSA or the CSS. While technically those things are true, or may be true, they don't usually have the impact that most people think. And the reason for that is because of the assessment rates, or the tax rates, if you will, on income versus assets. So income generally is assessed at a much higher rate than assets. So on the FAFSA formula, income is assessed anywhere between 22 to 47%. So think of it like a tax rate, right? You pay taxes anywhere between 22 to 47% for financial aid on the FAFSA for parent income. Student income is 50%. But assets are only assessed at around 5%. So on the FAFSA, it's 5.64. CSS is 5%. And for students, it's 20 and 25 for FAFSA and CSS. So that means that if you have $100 of income, it counts for much more in the formula than $100 of assets. So if you took that $100 of assets and you go bury in your backyard, the point is it just doesn't make that big of a difference. I mean, yes, technically, does it lower your SAI, so you could potentially qualify for more aid? Yeah, technically, but it just doesn't make a huge difference for most families. And because income is the one that counts, you're not going to go back to your boss and say, like, oh, by the way, you paid me this. Can you unpay me? Like, can I give you back part of my pay so it shows that you didn't pay me? Like, nobody does that, right? Like, we need our money to live on. So there are some differences. And so a lot of the things that you see on the internet may not be, while they may technically be true, may not really make that big of a difference or may be practical. Now that you sort of know this, a lot of times people say, well, don't save in your kid's name. Well, I would argue that if you don't qualify for need-based aid anyway, remember that basic overall formula, cost of attendance minus SAI minus OFA. If that bottom line number is negative, then it really doesn't matter if you save in your kid's name because you weren't going to qualify for need-based financial aid anyway. In fact, there may be times you may want to save in your kid's name, right? There are strategies for that, right? So it's not an automatic just don't ever save in your kid's name. That's not always the best strategy. Now, you might be thinking, okay, well, this is great, Jack, but so what, right? Like, so what? We fill out financial aid sort of after our kids fill out applications, apply to college. What's the difference? Well, I would say this. Because of the differences in the two formulas, depending on your personal financial circumstances, you may want to apply to schools that use one formula over the other. Right? Now, there's different situations, but as an example, if you have multiple children who are going to be in college simultaneously, right, because you have kids who overlap or you have twins, the CSS formula still accounts for the fact that you have multiple families or multiple kids in college at the same time. People kind of call it like a sibling discount. It's not really a sibling discount, but I suppose you can think of it that way. But the CSS formula takes that into account, but the FAFSA does not. If you're divorced, generally the FAFSA formula is going to be friendlier than the CSS because in divorced families, only one parent has to fill out the FAFSA. That's a whole nother topic for another podcast, whereas most CSS schools are going to require the custodial parent to fill out their CSS and the non-custodial parent to fill out the CSS. So that means in the FAFSA world, you might only have one parent's worth of income and assets, but in the CSS world, you're going to have two generally. Okay. And so there's other situations like this. If you have your own student debt payments or whatever, generally a little bit friendlier in the CSS world, or if you're younger kids, let's say attend a private high school or private elementary school, those are deductions in the CSS formula, but they're not automatic deductions in the FAFSA formula. Okay, so there's all these different sort of nuances. So if your financial situation is such that where it's more beneficial to you under one formula or the other, you may want to only look at schools that use that formula. So for example, if it's more beneficial to go to a FAFSA only school, then you may want to limit your school list to those that are FAFSA only, right? Or vice versa, right? If you're beneficial with the CSS, just depends. But we don't often think, right? Parents and guidance counselors certainly don't often think about that way. But obviously, not only do we want our kids to get to school, right, get into college and be successful, but we have to make sure we can pay for it, right? And so this financial aspect has to be considered up front. And one of the ways to do that out of the gate is to think about what formulas the schools use. Or if they're like Clark, where for a while they were a FAFSA plus, now they're CSS. So once you also know these things and sort of what's included, what's not included, things like that, that's when you can start to develop strategies. And so going back to the original formula, right, the same basic formula, if you are eligible for need-based financial aid, then what I would say is you have to be very careful with your finances so that you maintain that eligibility or even increase that eligibility. Now, when I say be very careful of finances, people often think like, you want me to like clip coupons when I go grocery shopping? And I'm like, no. No, I don't care where you go get your groceries. I don't care if you clip coupons or not. That's none of my business. That's not what I'm talking about. What I am talking about are big financial decisions. How you save, where you save, whether you save for you or in the kid's name. Taxes play a large part of this. So tax planning plays a role here, right? Those bigger financial decisions, and even necessarily sometimes like how you pay for stuff, like if you had to buy a car, how you pay for it, or if you had to move and sold your house, the timing of that matters because of how it hits the financial aid formula, right? You have to be very careful with those big decisions. But if that number is negative, so you don't qualify for need-based financial aid, then some of those things don't matter. Like I said earlier, you have more choices, right? So not qualifying for financial aid can be a good thing because you actually have a lot more financial flexibility. Do whatever you want, and the timing doesn't matter as much because you weren't going to qualify for need-based aid anyway. So who cares, right? But now, even within that, you want to be smart, right? I'm not saying like, who cares? Like, let's go on a massive gambling bender or something. Like, I'm not talking about that. But, right? But you have a lot more flexibility in your major financial strategies. Okay. So understanding the formulas now can be a huge part in college planning and should be considered a lot earlier in the process versus at the end, which is typically what happens now. I hope that this information helps you. I know I didn't really go into the super technical details of what counts, what doesn't count in the formulas. I know that will have to be another episode, but just sort of, if you understand this stuff in the broader context and consider it a lot earlier, then that puts you ahead of most families in this process. And that allows you to be, to get through college with a lot less financial impact, or hopefully a lot less financial impact because you thought about this up front. And that way you become a smart college buyer. Again, I hope this helped, right? Feel free to reach out with questions, but please like and share and subscribe to the podcast. As always, stay safe, stay healthy, and I'll see you next time. Thanks for listening to the Smart College Buyer podcast. I hope you found the information useful for your family. Follow me on LinkedIn for more episodes, videos, and tips. The link is in the show notes. Remember, you can spend time now to plan and strategize, or you can spend more money later. Success in college admissions and financial aid isn't about luck. It's about being intentional. I'm here to help you every step of the way.